At the end of the day, what interests me most about private credit or investing in private companies is really the fact that you're going along and underwriting and participating in small companies growing from medium sized to large or from small to medium and helping them get to the next stage.
Welcome to another episode of What's the Alternative? I am Shana Orczyk Sissel, founder and CEO of Bond Capital Management, a platform to help advisors allocate in a scalable way to alternative investments. Today, our guest is John Sateri from Gladstone, where he is a managing director. He's been with the Gladstone Companies since April of 2007, so he joined at a very interesting time. Prior to Gladstone, he directed independent consultancy, providing special situation investment sourcing, underwriting, and disposition services to institutional investors across a variety of asset classes, including some of the areas we're going to talk about today. From 1989 to 1998, John worked at Wells Fargo in a variety of areas, including commercial lending, special assets, and lastly, capital markets, where he was vice president and senior portfolio manager, overseeing a team responsible for underwriting, servicing, and managing asset-based loan portfolios with over $500,000 in commitments to highly leveraged, growth-oriented middle market companies. He's on a number of boards and holds a bachelor's in administration from the University of Hawaii, which is cool, because Hawaii is awesome, and a master's degree in real estate development from the University of Maryland. With that, I'd like to bring John in. Welcome to the show, John.
Thanks for having me. Looking forward to our conversation.
Awesome. Well, thank you for being on the show. Gladstone is one of our newest partners. And one of the things that makes Gladstone so interesting is the Gladstone Companies have been doing alternatives in a accessible wrapper for a long time. Your interval fund is fairly new, but you've had business development corps that trade via ticker on traditional indices as well as preferreds, non-traded preferreds for a while in spaces like agriculture, real estate development, and private credit. Talk a little bit about your background in the private credit space, sort of what makes you so interested in private credit, why you think it's so interesting today, and how the Gladstone Companies is sort of approaching private credit.
Sure, no, I appreciate it. As you sort of read through my bio, I've been sort of doing the same thing for a very long time. And at the end of the day, what interests me most about private credit or investing in private companies is really the fact that you're going along and underwriting and participating in small companies growing from medium sized to large or from small to medium and helping them get to the next stage. And unlike public market investing, private company investing just requires a lot more hands-on, rolling up your sleeve. We have to develop the diligence and information ourselves, as opposed to kind of relying on readily publicly available information. So we engage with all sorts of third parties to dive deep into the business models, the operating performance, and the industry to learn about new businesses every day. And that's really what we do. Is at the end of the day, we're students of business models, right? And it's very interesting, and you learn something new every day. And that's kind of what attracted me and kept me in the business all these years.
Well, it's interesting because, as I noted, you joined the Gladstone Companies in April of 2007, which is, in the private credit world, that's a real interesting time. Can you talk a little bit about the experiences you had at that time? Obviously, private credit has become a much more important part of capital markets today than it was prior to the financial crisis, as changes in the way that traditional banks lend have kind of opened the door to non-traditional lenders for a lot of businesses. And so how have you seen it evolve from when you joined the Gladstone Companies in 2007?
Sure, no, that's a great question. And I think it's a good topic for Gladstone, because when I joined Gladstone, you mentioned some of the other fund structures and wrappers we use, including business development companies. There were probably 24 or so BDCs out there. Since then, post 2010 thereabouts, of course, that population of formation structures has exploded. And when I started in 2007, Gladstone was already around in its current form since 2001. It was certainly an interesting time because at that time we had the GFC, and you had a lot of stress that came on a lot of middle market and lower middle market portfolio companies. And what we learned from that experience is, as a principal investor, as being very close to the businesses, we didn't panic. We tried to figure out how to help the businesses get to the other side. Now, 2008 was obviously different than other cycles we had been in, because there was also a liquidity crisis. So for BDCs, it was difficult to raise public equity, which was probably a good segue in a little while in terms of why we decided to also have an interval fund. But the lesson learned from 2007-8 is that, look, as long as you diligently deploy capital and stick to your knittings and do what you've been taught to do, you can get to the other side. And it may not be a high growth strategy from an assets under management perspective, but it withstands the test of time. And I think if you look at the body of BDCs and other funds out there right now, we're one of the few, I think probably less than 5%, that have experience that dates back that far. So we've been around a while, we've seen it all. And one of the selling points for Gladstone is simply that, is like, look, we want to help the businesses grow, right? And we're here to provide growth capital. And fundamentally what we do is we invest in a plan that either management has to grow the business, or a plan that management and the private equity firm is developing or has a thesis around, or one that we're sponsoring. So we're very much focused on sort of a long-term horizon of investing, and that's kind of what it takes when you're dealing with smaller, private, lower middle market companies.
I think what you said is really interesting. There was something you said there that I found particularly interesting as it relates to what you went through in 2008, and that you really got your hands dirty but working with your companies, which is very different than the traditional banking model. Yes, some banks have workout groups or whatever, but I do think one of the benefits of private credit for a business, a small business or otherwise that might have difficulty tapping the banking system, is that private credit teams tend to be willing to go in there and work around and help the company, if it finds itself in a stress situation, find a way to ensure that the company can make through that. Even if in the short term, maybe you don't get paid or you do something like that, but really the focus is ensuring that the company will be able to pay back the debt, even if in the short term it's under stress. Can you talk a little bit about, the advantages of doing that, and why, that can be really helpful to people investing in private credit?
Sure. No, that's a great point. You brought up banks, and I'm a recovering banker, and the challenge with commercial banks is the focus for a long time tended to be around making loans and focusing very much on the collateral, right? And banks are very highly levered, 8, 9, 10 times leverage, and there's very limited capital that you can play around with. Whereas, even LP funds, BDCs certainly have very low leverage, and interval funds have even less leverage. It gives you more cushion and opportunity to work through the downs and get to the other side, as I mentioned. So when we talk about, trying to support a business, whether it's going through a systemic low or a economic bump in the road, all we're really doing is we're reverting to our original thesis and interest in the business, right? Do those key pillars still hold true? And if so, then it's simply a matter of either bringing in additional talent, bringing in additional capital, restructuring the stack in order to get the team to the other side. Whereas when you're talking about banks, and you mentioned workouts, and I used to sit in one of those seats, it's a much different environment. You have to clean the balance sheet, right? And there's a lot of pressure to get rid of those kinds of assets. Whereas as a private credit investor, where we're more focused on the enterprise value and the cash flow generation of the business, as opposed to necessarily the hard collateral that you can liquidate, then it sort of gives you a different view in terms of the world, and as well as the horizon for a business, right? And that's what I would say is kind of the main difference. And I can't overemphasize the fact that you mentioned BDCs are relatively low leverage fund structures versus banks, and even versus some LP fund structures, and certainly compared to CLOs. So that really informs how you're able to sort of go in your toolbox and fix a problem.
I think one of the things that you said there is something that I'm not sure a lot of folks appreciate about private credit versus public credit. And when you're dealing with traditional banks, commercial lenders versus private credit, non-traditional, non-bank lenders, which is, you said that a lot of it is focusing on the enterprise value of the business and the cash flows of the business, and not necessarily as their collateral. And that, I think, to your point, allows you to, if a company is going through a difficult time, if their cash flows, have some issues as it's relating to like client invoicing or whatever, to sit down and work with the company to get them back to that right place, because you're not worried about like, okay, what can we liquidate, which might very well, as you point out, put the company in a worse situation, not a better situation. And in a way, you charge a higher rate because of that aspect of the business, but also, as you point out, not having leverage. I think all of those things are really interesting. When you look at the current environment and how much private credit has grown in importance to capital markets in general, what are the key things you see today that continue to get you excited about private credit?
Sure. One of the things that excites me is that over time, private credit and alternative capital has been displacing commercial bank capital, right? So just because of the flexibility, the focus on the enterprise, the ease of being able to interact with management, the board, the sponsors, the flatter organizations at private credit funds in terms of rendering a decision, the speed by which you can get back to a client or customer. We don't have multi-layer investment committees or credit committees, or these structures that are really predominating now through these large bank systems, right? People have to go through various layers, and there's a lot of time lag. So naturally, private credit and alternative capital has been displacing, the proportion of lending activity or investment activity compared to commercial banks. Now, commercial banks still hold the bulk of, I think, loan assets out there. I think some number near $13 trillion, I think. And I think private credit is somewhere probably around $1.5 to $2 trillion. So it's still small. So we have a long runway of growth ahead of us. And, that's kind of exciting. Now, you mentioned, cost of capital. Certainly cost of capital for any LP, any BDC, or even interval fund is going to be a lot different than a commercial bank, simply because, we don't have free deposits to lend out, at SOFR plus, 200 or 300, right? We are raising debt, we are raising equity, and we have to deploy that at, a spread that's closer to 500, 600, 700 basis points, sometimes more, depending on where you are in the capital structure. But, what I think we see in the market is that for sponsors or even management teams, when you have someone that is aligned with you to support the plan, whatever that growth plan is, then it is worth that extra interest expense, whether it's cash or PIK or whatever the case may be, in order to enhance, at the end of the day, the equity value, right? And that's really what we're here to do and what private credit is here to do. And a lot of times, if we have conviction and we have the ability to get equity co-investments, we do that, right? Because not only does that align us with the ownership, but we have an opportunity to get an accretive yield that acts as an additional opportunity for special dividends down the road, or it can even act as a buffer against, losses, right? We're going to have losses, and some things are inevitable, but that's the added flexibility that these private credit funds, including us, have relative sort of the commercial bank rigid parameters that they have to operate under, and rightly so, because they're holding our deposits. We want them to be in, ultra safe and very conservative end investments, especially in light of the amount of leverage banks have.
Mm-hmm. No, that makes perfect sense. You talked about BDCs versus interval funds. One of the trends right now in private credit is the interval fund, and actually even ETF structures. I have my own opinions on the fully daily liquid forms and the limitations there, and also the impact it could possibly have on private credit as a whole, in terms of its key attributes, like kind of disappearing. But let's talk a little bit about that BDC to interval fund kind of move that the Gladstone Companies has made. You've had the traditional BDCs in the market for a while. Typically the issue with BDCs is that they don't always correlate to the market that you're invested in, because they are still equity tickers trading on equity exchanges. So they get really difficult for people to kind of get the true benefit that they are expecting in the way that they expect through those structures. Where the interval fund is a lot closer to the traditional LP private placement structure, with some wiggle room there. Can you walk us through kind of the thought process on launching the interval fund, as we're seeing more and more of that? And one of the things I'd love for you to touch on is like the important limitations of the interval funds, because number one thing that I worry about with interval funds is not so much whether or not they're a good thing or a bad thing, but more there's nuance there. And I'm not sure that most people understand the nuance to an interval fund.
Sure. I mean, first, I'll take the first part about, why Gladstone and why do we go with an interval fund, opportunity here. And for us, we have the BDCs, and, we are operating our equity capital in a publicly traded, very liquid environment. And that works when everything is operating normally in the capital markets, but when it doesn't, or when it's disruptive, it is volatile, right? So you will see, NAV fluctuations depending just simply by what's happening out there, not necessarily things specific to your assets, to your fund, or what have you. Now, what that does is, what the challenge that creates sometimes is your ability as a BDC to access the equity markets, so you're not trying not to sell new shares below NAV, and to continue to support, as I mentioned, the plan for the businesses that we invested in, right? So when we talk about trying to invest in a business, either when things are, challenged, or even when things are going well, part of what we do is we provide follow-on growth capital, right? The simple, example is, here's a platform business and it's going to buy other similar platform businesses. Now, we're not going to extend the capital to them up front, but as you find the next opportunity and you want to buy it and create synergies and improve your margins and scale and get a higher potential multiple on exit, you have to buy stuff. And for us, we do that oftentimes in the form of either an accordion facility, which is uncommitted capital, or a DDTL, delayed draw term loan, which is committed capital. So when you have disruptions in the equity capital markets that make it difficult for you to raise equity to continue to invest in your businesses, that's somewhat of a problem, right? I mean, you want to...
Especially because during those times of equity disruption, it's usually the best time to do some of the things you're talking about.
It's a good time to buy stuff, exactly. So,
yes.
So the interval fund provides, a different and sort of market in terms of holders. It's obviously a non-traded security, and from an investor standpoint, it obviously is not going to exhibit the same kind of volatility either. Now, if you think about interval funds and you're invested in it and you're interested in having some exposure to private debt or private capital in your portfolio, right? And what you're really saying is, look, I don't want to go and buy something on the S&P 500 where so I have to buy a company essentially at a high teens or 20 times EBITDA margin. I want my end money to be in something that is purchased effectively and levered even less at 6, 7, or 8 times, because I want the opportunity of that multiple arbitrage for that business to grow. So what that really means is that you're buying into the concept of a longer term horizon than trading in stocks, right? When you're talking about investing in these small businesses, that doesn't happen overnight. It takes 3, 4, 5 years to institutionalize, to pursue the plan, to build out the management, to build out the systems, for the people around the board to provide the adult supervision, so to speak, to get it to where they want it to be. And if the plan for the business and the investment is a 4, 5, 6 year plan, then you as an investor in the stock of the interval fund should think of it in that term, right? As opposed to, hey, I want to sell this tomorrow. So if you need immediate liquidity, you probably shouldn't be in an interval fund. But if you're looking for steady income, and income is the key focus, then it may be a good alternative to get exposure to smaller businesses, while at the same time having a safety valve for liquidity, right? And that's sort of what the unique element of the interval fund is, simply that you're not locked up similar to LP funds. You have that, 5 to 25%, mandatory redemption where you sort of can glide path when you need to as an investor to liquidity. And that's why, for us, we thought adding an interval fund structure to the family of funds here made sense. It diversifies our capital source, and it is very consistent with how we invest in the first place.
Yeah, I think what you said there was interesting, and I always like to point out to my audience, you have a liquidity valve to a point. I think it's really important to emphasize that it is a limited liquidity, and it does happen over time. So there's not going to be a scenario in most cases, I don't want to say 100% of the time, where your client would be able to get their entire investment out at once. It's going to take time. And to your point, for some drawdown LP structures, you might have no liquidity at all for a period of time, but also a secondary market that doesn't really exist in the interval fund world. So that's consideration. And then in private credit, there are evergreen private credit funds that have just very clear, quarterly liquidity with 60 days notice kind of thing. And so all of those things need to be considered. But I think the point you're making about having a liquidity safety valve is an important one to emphasize. The never or highly unlikely to be the entire investment in a single quarter. And that is something that I don't know that we emphasize enough.
Yeah, I think what we look for, the same way, the companies that we invest in look for, a partner, right, to help them get from A to Z, so to speak. The way that interval funds are set up is that as an investor, you can see exactly what we invested in, right? And it's very digestible and understandable, at least for a firm like Gladstone that invests primarily in proprietary kind of lower middle market businesses, right? So you can go on the website and say, all right, we've invested in a business that processes, all the honey for the East Coast of, the United States, right? So, or makes weather measurement instruments. It's like really what, most of the businesses out there are, and you're a part of it. Now, you can't invest as a retail investor directly into those private companies. The vehicle is through an interval fund, through an LP fund, or through a BDC for the most part. And the difference between an interval fund and, let's say, a traditional LP fund is that interval funds, like BDCs, have the layer of public registered chartered company framework where we have to abide by the audit standards, the public reporting standards, everything else. So from a valuation standpoint, from a compliance standpoint, from a governance rigor standpoint, it's like investing in most other public companies similar to BDC. So you get a little bit of both, I would say.
Yeah, that's a good point. Let's dive into where you invest. So you talked a little bit about lower middle market. I'd love to walk through, that area of the market, define it for our audience, and then talk about how the due diligence works for that part of, the capital markets and those types of clients for lending perspective.
Sure. Look, everyone has a different definition, but in terms of what the lower middle market is, right? It's how low.
Yes, that is 100% true. I've had lower middle market people tell me that is loan sizes between $1 million and $2.5 million. And I also had somebody tell me it was between 5 and 10 million. So yeah, it can be.
I would define it this way. I think, anything under 150 to 200 million in enterprise value is, lower middle market, right? Okay. And for Gladstone specifically, we try to contextualize the size of the business in terms of EBITDA or cash flow. So we'll say roughly between $3 and $30 million. Now, do we have some businesses that are slightly less and some that are larger? Yes. Some of them have grown during our hold period to the point where they are in excess of those parameters. But those parameters are relevant only because they inform the check size that we would write. So if we have a $10 million EBITDA business and we don't want to lever something more than 4 times, we'll write a $40 million check size, which is sort of at the middle ground for at least our BDC. Certainly the interval fund right now is not going to be writing checks that large because we're just starting to raise equity. But the interval fund for Gladstone is a co-investment fund, so it will participate with the other 2 BDCs in the securities that they invested in. So that's kind of what I would describe as the lower middle market for us. In terms of process and what does it look like, I mean, the basic process is we get opportunities from a variety of sources. Management teams, investment bankers, private equity sponsors, and other relationships, consultants, advisors, you name it. And these are opportunities where someone wants to sell their business or take out a shareholder or buy another business. And what we typically find, at least on the leverage side, is a sponsor that will have the opportunity under a letter of intent or commitment where they've locked it up for some period of time to do some additional diligence to prove out, sort of the big rocks of what we would like to know. And at the same time, they'll go to the lending community, the private credit community to gauge interest on it. But what's different about, investing in these private companies is we have to develop our own industry reports. So we'll commission third parties and dialogue with experts about a particular business model or a particular industry or a particular segment in an industry. We'll do background checks on the management teams. We'll evaluate the management teams. We'll do quality of earnings, because a lot of times these smaller businesses will not have had audits per se. So we have to really dig deep into being able to rely on the financial information. And even if they have audits, oftentimes we'll do or commission a quality of earnings report, because what we want to see is not only historically what they have done, but also what the plan is going forward and how those adjustments look on a go-forward basis. And that's really the key element of our type of investing, is that we are focused on what's going to happen in the future and what kind of capital structure to lay against what the business will look like in the future after the transaction, not what it was in the past. So, a lot of third-party reports, a lot of diligence, a lot of management interviews, spending a couple months learning about businesses, and then finally tailoring, the amount of debt, the pricing of the debt, the amount of equity, the nature of the equity in a way that makes sense for that business.
Yeah, that's, as you're talking, it reminds me a lot. Obviously, Bonrian is a small startup technology firm, and we are out raising capital right now. A lot of what you're talking about sounds a lot like when we talk to potential investors, how they approach us, right? It's really about, the plan, the execution of the plan, the probability and the realistic nature of the plan. Does it make sense? Does the industry make sense? So, in a lot of ways, if you think about it, as advisors consider these types of things for their clients, it's sort of like a cousin or a relative of like the venture world and the private equity world. Similar approach, just how you're investing your capital and where you sit on the capital structure is a little bit different. With private credit, typically not going into that earlier stage startup world, but also not necessarily in that highly developed, in the lower middle market anyways, highly developed like growth equity, private equity kind of world either, where you're talking about like taking a company private or acquiring, like one large company acquiring another large company, things of that nature. So it kind of sits in that little sweet spot where, again, you point out the income. As people evaluate these types of strategies, what kind of income and coupons are you looking at here? And in a rate environment like we see today, how do changes in overall rates impact this market, or does it impact it at all?
Yeah, that's a great question, and it certainly does. Maybe what I'll do is I'll go back 2 or 3 years to kind of set the stage, and late 2022, when the Fed started raising rates, a lot of things happened that was beneficial to the alternative credit, private credit investors or funds, in that by raising rates from 0 to near 500 and around 500 basis points before they sort of flatten out, what it did is it boosted the nominal income and the dividends that these private credit funds were able to pay to their shareholders. So it was a great time, very profitable, and a lot of investors in BDCs, interval funds, LP funds got used to pretty rich double-digit coupons, right? Because of the rate environment, and because most of the exposure, most of the investments are in variable rate structures, right? So that's kind of how we manage, our balance sheet, so as not to take sort of that risk. The other thing.
So I just want to interrupt, if you don't mind, because as you talk about variable rates, I'm just curious. the way that used to work is LIBOR plus. Now LIBOR doesn't exist anymore. So how do you guys do your variable
Yeah, so
rate
we're SOFR
calculations?
based for the most part,
Okay.
and think of it roughly date going back 30 years now, sort of like as a Fed funds type of a framework. But it's very similar to LIBOR. We just swapped it out, SOFR, right now I think is at 4.25, 4.3 thereabouts, 1 month SOFR, and then we add a spread or a risk premium to it, and depending
Mm-hmm.
on the type of business, the size, the leverage, that could be anywhere from, at least for private credit, anywhere from the 500 basis points to 7, 8, 900 basis point if you're for a second or a junior lien type of a structure, versus I'll put it in context for banks that might be doing SOFR 200 or 300.
Right.
Certainly in the broadly syndicated market, you see a lot of SOFR 3 to 400, type paper, but that's also a little bit of a different, end market. So that's, the general pricing. But in terms of, the rate environment, in addition to, the Fed raising rates in, 2022, we're now at a point where that has sort of flattened out and is expected to go back down, right? So, we're
Yeah.
projecting on a SOFR curve basis. Well, we had projected more than it actually turned out. It keeps getting delayed, a reduction of 25 to 50 basis points, over the course of 2025. That has not happened yet. Maybe it'll happen in September or thereabouts. But the point of it is that by SOFR going down, the company's borrowing costs will go down, and the earnings of all the credit funds that are, very much variable loan based pricing is also going to have to come down. So the yields will have to
Mm-hmm.
come down as well. So I only mention that because people have gotten used to double digit, private credit fund type yields, and that works as long as rates remain elevated. Now,
Sure.
we're very concerned about that as an asset manager from a borrower perspective, because you sort of get to a tipping point. It's great for us to get more interest income, but it could strangle these small businesses to a point where it no longer works for their capital stack. So one of the things in the lower middle market versus the broadly syndicated market, the amount of leverage that we are comfortable putting on the business tends to be a lot less, which by
Mm-hmm.
extension makes a lot of sense if you think about what we're paying or what the sponsor is paying for the business. So if you're paying 6 or 8 times, you're not putting 6 times leverage. You're probably not putting
Right.
5 times leverage. You like to be in the 3 to 4 range. So as long as it's adequately structured without too much leverage, I don't think you have to worry about rates with regard to portfolio companies, tipping. But it's a real concern as an investor.
Yeah. So, just for our audience, I think sometimes we take for granted that people know what these acronyms mean. LIBOR stood for London Interbank Offering
Yeah,
Rate.
London Interbank Offered Rate, I think, is what it
Yes, and SOFR stands for
secured overnight, funds
fund
rate.
rate.
Yeah.
Yes. All right. Just see, just even I'm like, I have to think about it. But that is, as we use these terms, I think it's important. LIBOR ceased to exist a couple years ago, and SOFR took over as the standard rate because it's sort of the international average, if you will, which is different than the underlying U.S. Fed funds rate, which is what the banks tend to use because it's most relevant to them. I think, as we kind of come to the end of our time, it would be super helpful to talk a little bit about the Gladstone Companies and sort of how you guys are thinking about private credit, and as you kind of grow your interval fund business, where you think the opportunities a lot, and for our audience's benefit, the BDCs that the Gladstone companies have go beyond private credit. You have some real estate, you have agriculture, things of that nature. Is there plans at the Gladstone Group, depending on how the first attempt with the interval funds goes, to potentially move some of those other types of assets into an interval fund structure?
Yeah, I'll try to answer that, sort of.
Without making your compliance
Yeah,
team
exactly.
mad.
It's like, someone's going to throw a pillow at me in a second. I think,
Yes.
this R interval fund is primarily a co-invest fund with the BDCs to start out,
Yep.
but it will also co-invest and do direct investments depending on the sort of cadence of our equity raise. It is structured to sort of be a blend between Gladstone Capital and Gladstone Investment. Gladstone Capital is more of the leverage fund where 90% of its capital is in the form of debt securities, 10% is equity. And then Gladstone Investment is, weighed a little bit differently, 75% debt, 25% equity. So definitely investing more in the equity securities of these small businesses. And the interval fund is sort of designed to be right in the middle at 85-15.
Mm-hmm.
And additionally, the interval fund has some broader, I guess, investment capabilities or mandates. You mentioned, our farm REIT and then our commercial triple net REIT. The interval fund is not going to be buying real estate, but it can invest in real estate debt. And, we're sort of in an interesting time as far as real estate debt is concerned. And, you mentioned it earlier, it's not a great time, but there are probably some good opportunities, right? So although the BDCs wouldn't be investing in the debt of, real estate concerns, the interval fund could, but it's not a primary mandate. It's really more opportunistic, and depending on what happens in certain verticals of the real estate market, it could invest in that. So I don't know if that answers your question, but
no, it definitely helps. I think it helps our audience. Interval funds are so new to a lot of people. I think that even purchasing one has its own quirks, as I'm sure you're aware. But it's an interesting opportunity because, as I alluded to earlier, we're seeing more and more people wanting to put private credit and these types of products that are in less liquid markets into more liquid structures. And I think that there's real risks associated with that. And as our audience and the advisors that listen to this podcast are thinking about different ways that they can help all of their clients access private credit, I think it's worth considering that, to get the key benefits of private credit and really the income opportunities, the interval fund's going to do that better than, say, a fully daily liquid ETF that's going to have a large chunk of the underlying assets and something outside of private credit to be able to maintain the regulatory required liquidity needed for those products. So just food for thought for our audience. Most of the interval funds that have come to the market have been more in the real estate world. So we're starting to see others, but it's not a ton of interval funds, maybe 300 today. Yeah. It's just worth considering working with a company like the Gladstone Companies, where they have a very long history in the space. And really, it's just taking something they've been doing for a long time and putting it in a structure that makes sense for the underlying. And the co-invest part is also quite interesting. So I think that's worth kind of emphasizing as well.
Yeah, no, I appreciate it. Like I said, we're not doing anything new or different. We're only doing what we've always done. And that's, I think, kind of the key attribute about Gladstone. And, our organization, even though we invest in real estate, at the end of the day, we're very much focused on underwriting capital to the lower middle market. It just happens to be that on the real estate side, we're underwriting a single tenant that is operating in a piece of real estate where they need to manufacture the widget. But what we do is exactly the same, but instead of providing debt or providing equity, we're buying the real estate and then renting it to them, right? So it's very much a lower middle market centric cash flow underwriting dividend-oriented organization, and that's what we'll continue to do.
Well, I appreciate your time, John. I think our audience will find this very interesting, as you guys are one of the leading providers of private credit in the interval fund structure, and are doing it in a really unique way. So thank you so much for your time. I'd like to thank everyone for listening to this episode. As always, hit that like and subscribe button. Please leave a comment. Let us know what you thought of this episode. Let us know what you're interested in hearing, what is on your mind, and we'll work to make sure that we are putting out content that is timely, that our audience is looking for. So with that, I am Shana Orczyk Sissel, founder and CEO of Bondring Capital Management. This was What's the Alternative? And until next time.
The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Bondring Capital Management's platform. As such, Bondring may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Bondring Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Bondring Capital trademarks mentioned are owned by Bondring Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.